Welcome to your daily Solo 401k webinar and Q&A session with my Solo 401k Financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic: does Fidelity Solo 401k allow after-tax contributions as part of the Mega Backdoor Roth strategy? You'd be surprised how many self-employed professionals, consultants, real estate agents, and even physicians assume they are getting all the features with the Fidelity Solo 401k, when in reality, they are missing one of the most powerful tax-free growth strategies available. Let's start with what after-tax actually means. In a solo 401k, there are typically three contribution types: pre-tax, which lowers your taxable income for the year; Roth, which are taxed in the year that the contribution is made, but the gains will grow tax-free. And then there's the after-tax, voluntary after-tax contribution. So they are contributed on an after-tax basis, but they can be rolled into the Roth Solo 401k or to a Roth IRA, creating what's known as the Mega Backdoor Roth strategy. So this third bucket, the voluntary after-tax, is what unlocks the potential to contribute well beyond the normal annual Roth Solo 401k limits. So this is your chance to get answers. Use the chat to ask questions on today's topic or anything else. Chat them over now so that we can be sure to get to them all. Let's continue. So here's where most people get tripped up. While Fidelity Solo 401k is great for basic investing, it does not allow for voluntary after-tax contributions. This means you cannot do the Mega Backdoor Roth inside a Fidelity Solo 401k plan. You are limited to just the employee and pre-tax contributions, missing out on potentially tens of thousands and additional Roth dollars each year. So before we continue here, let's make sure you understand that you need to be eligible to open a solo 401k plan. Whether you open a solo 401k plan that allows for the Mega Backdoor Roth strategy from a provider like my solo 401k Financial, to opening up just a regular solo 401k at Fidelity or Schwab, for example, that does not allow for the Mega Backdoor Roth strategy, you still have to meet the same eligibility requirements with respect to being able to open a solo 401k plan. Those key requirements are: you must be self-employed with no non-owner full-time W-2 employees who work 1,000 hours or more in any of your businesses. So if you own multiple businesses, you're going to have to apply this test to all of your businesses. And if any of those businesses employ any non-owner full-time W-2 employees who work 1,000 hours or more, you would not qualify to open a solo 401k. Of course, there's the spousal exception. So even if your spouse is not an owner in your business, but if he or she does work in your business, you could still open a solo 401k plan, and your spouse can even participate in the plan. Therefore, you could both participate in the same solo 401k plan. So from an eligibility perspective, this means you can have part-time employees who work less than 1,000 hours when you're looking to open the solo 401k plan. You can also exclude independent contractors. So if your business hires independent contractors, so 1099 NEC employees, it doesn't matter how many hours they work, as they can be excluded from the plan. Same thing with someone who's under age 21. you can exclude those who are age 21 and under, who are under age 21, from participating in the plan. So even if you employ full-time W-2 employees who work 1,000 hours or more, as long as they're under age 21, they can be excluded from the plan, and therefore you would qualify for a solo 401k plan. Okay. So the mega backdoor Roth. So you make a contribution to the voluntary after-tax solo 401k, and then you convert that over to the Roth solo 401k or the Roth IRA. So it goes into this bucket right here titled voluntary after-tax. That's the after-tax bucket. And then you convert it to the Roth solo 401k, or it can be converted to the Roth IRA. And what's great about the mega backdoor Roth strategy is that the annual contribution limit each year changes. For tax year 2025, for example, the overall contribution limit is $70,000. So you can contribute that entire $70,000 to the voluntary after-tax solo 401k bucket. So this bucket right here, and then immediately convert it to the Roth solo 401k or the Roth IRA. Now, the solo 401k plan does allow for catch-up contributions for those who are age 50 or older. That's known as the normal catch-up contribution, which is $7,500. And it also allows for the super catch-up contribution, which is $11,250. Now, the catch-up contributions cannot be applied to the voluntary after-tax solo 401k bucket. Instead, those catch-up contributions would get deposited directly to the Roth solo 401k bucket. So if you're age 50 or older, you can make a catch-up contribution of $7,500, and you would deposit that to the Roth solo 401k bucket, not the voluntary after-tax solo 401k bucket. So even though you cannot utilize the catch-up contribution as part of the mega backdoor Roth, it doesn't matter, because remember, the purpose of the voluntary after-tax solo 401k contributions is to indirectly get more Roth solo 401k funds into your solo 401k plan. Well, the catch-up contribution, even though it cannot be deposited to the voluntary after-tax solo 401k bucket, you can deposit that directly to the Roth solo 401k bucket. Same thing with the super catch-up contribution, which is for those who are ages 60, 61, 62, or 63. So if you fall within that age range, instead of contributing the $7,500 catch-up contribution, you can contribute $11,250. And just like you cannot deposit the normal catch-up contribution to the voluntary after-tax solo 401k bucket, you would deposit that super catch-up contribution directly to the Roth solo 401k bucket. So in short, the maximum mega backdoor Roth amount that can be utilized for tax year 2025 is the overall limit of $70,000. You can never utilize the catch-up contribution as part of the mega backdoor Roth, but again, that's a moot point, because you can deposit those funds directly into the Roth solo 401k bucket. So this bucket right here, the Roth solo 401k bucket, you would deposit those directly into that brokerage account there titled Roth. So if you notice this slide, this is an example of a one participant plan where you've got 3 holding accounts. So one plan, the plan is sponsored by the self-employed business. You are the participant. A solo 401k is a defined contribution plan, so you are required to have separate holding accounts, aka bank or brokerage accounts. That's why this illustration shows a total of 3 holding accounts, because you have to segregate each source of funds. So you have to separately track the pre-tax funds, the Roth solo 401k funds, and of course the voluntary after-tax solo 401k funds. This slide here is an example of a 2 participant plan. So this here Same concept, it's one plan, but let's say both spouses work in the same self-employed business. So they can both participate in the same solo 401k plan, and therefore they can each utilize the mega backdoor Roth strategy under that solo 401k plan. So here's an example of a two-participant plan. So a total of 6 holding accounts, whether bank or brokerage accounts, 3 each of pre-tax Roth and voluntary after-tax for each spouse. So a total of 6 holding accounts. So each spouse can utilize the mega backdoor Roth strategy. For example, for tax year 2025, let's say Bill and Janet are married and they're working in the same business. They would set up just one plan sponsored by, let's say, their self-employed LLC, and then they would each have separate holding accounts. If they each pay themselves $70,000, and let's say the LLC is taxed as an S corporation, if they each pay themselves $70,000, so they each get a W-2 of $70,000 for tax year 2025, they could each contribute that $70,000 to their respective voluntary after-tax solo 401k bucket, aka bank or brokerage account, and then convert that over to the Roth Solo 401k, resulting in $140,000 in Roth Solo 401k contributions for tax year 2025. So again, the voluntary after-tax solo 401k contribution is a way to indirectly get more Roth Solo 401k funds into your plan. And so that allows you to contribute more than you typically can in Roth Solo 401k contributions. Okay, if this information is helping you feel more confident about your future, please take 1 second to like and subscribe. It tells the platform this content is valuable, which helps other solopreneurs like you to find it. Subscribing guarantees you get notifications of all of our crucial content that we deliver every day to help you secure your retirement. So again, the purpose of the Mega Backdoor Roth Solo 401k strategy is to get more Roth Solo 401k funds in your plan or Roth IRA on an annual basis. So who can utilize this strategy? Well, this powerful contribution mega backdoor Roth Solo 401k contribution strategy is perfect for self-employed individuals who have earned income from their self-employed business. Because remember, in order to make any type of contribution to a solo 401k plan, whether it's pre-tax, Roth, or voluntary after-tax contributions as part of the mega backdoor Roth strategy, you have to have the necessary earned income from self-employment activity to support that contribution. In other words, you can't just shift personal income or capital gains income and treat that as a contribution. You have to actually have the required earned income from self-employment activity for the year that you want to make that contribution to the solo 401k, whether voluntary after tax, Roth, or pre-tax. That's the purpose of a solo 401k, is to make contributions for someone who's self-employed and has earned income from self-employment activity. You also cannot contribute more than you make. So if you don't make enough net self-employment income, you may not be able to utilize the full mega backdoor Roth strategy by contributing the full $70,000 contribution limit for tax year 2025 to the voluntary after-tax solo 401k, and then converting it to the Roth Solo 401k. So you have to have the necessary self-employment earned income from your self-employed business in order to make that contribution, and it has to be earned income. It cannot be capital gains income, investment income, or passive income. That's very important. So who else can use this strategy? Well, high earners. So if you are a high earner in your self-employed business, you can utilize the mega backdoor Roth strategy. And of course, business owners with no full-time employees other than your spouse. So freelancers and consultants who report Schedule C or 1099 NEC income, they would qualify. Of course, S corporations, C corporations, LLCs taxed as a sole proprietorship, LLCs taxed as a partnership, LLCs taxed as an S corporation. bottom line, it's not the entity type that determines whether or not you can open a solo 401k and make contributions, is the actual underlying activity, which needs to be self-employment activity, material services. You're doing the actual work to produce that earned self-employment income. So you're self-employed, in short. So we already went over this slide here. This is an example of a one participant plan. So let's talk about how the Mega Backdoor Roth strategy works. So with the Mega Backdoor Roth strategy, you first make the voluntary well, number one, you need to open a solo 401k plan with a provider like my solo 401k Financial, who offers a solo 401k plan that allows for voluntary after-tax solo 401k contributions as part of the Mega Backdoor Roth strategy. So the Fidelity Solo 401k does not allow for the Mega Backdoor Roth strategy. So don't get confused, because Fidelity offers their own solo 401k plan, but they will also provide what they refer to as non-prototype investment-only brokerage accounts for a solo 401k plan offered by my solo 401k Financial. So yes, many of our clients will transfer their existing solo 401k from Fidelity to a solo 401k from my solo 401k Financial, so that they can utilize the Mega Backdoor Roth solo 401k strategy. And we're going to talk more about that process in a moment. But once you open that solo 401k that allows for the Mega Backdoor Roth strategy, then you're going to make that contribution to the voluntary after-tax solo 401k bank or brokerage account under that solo 401k plan. Then you're going to move it, that is converted to the Roth solo 401k or to a Roth IRA. Once you do that conversion, then that needs to be reported to the IRS. That conversion needs to be reported to the IRS using Form 1099-R. Here at my solo 401k Financial, we'll file that Form 1099-R for our clients who timely requested, and that's covered in our annual fee. And we have an online form that you would fill out so that we collect the necessary information to issue that Form 1099-R. And whether it's not going to be a taxable conversion, there might be small gains, but you want to convert that voluntary after-tax solo 401k contribution immediately so that there are just small gains. Just the small gains will be taxable when you convert those to the Roth solo 401k or the Roth IRA. But the bases will not be taxable. So converting after-tax funds to the Roth solo 401k. Here's an example here. So let's say you utilize my solo 401k Financial to open a solo 401k plan that allows for the Mega Backdoor Roth strategy. So we've helped you to open up the brokerage accounts at Fidelity. So we would help you open up 3 brokerage accounts here. Here's an example: a pre-tax Roth and a voluntary after-tax if it's a one participant plan. If it's a 2 participant plan where both spouses are working in the same business, then we would help you to open up 6 brokerage accounts at Fidelity, 3 each for each of you, for a total of 6. So it's not 6 separate solo 401k plans. It's one plan that allows for these various contribution types. So once we help you to open up those brokerage accounts at Fidelity, for example, for the solo 401k from my solo 401k Financial, then it's time to make that voluntary after-tax solo 401k contribution. So you'll make it to the voluntary after-tax solo 401k bucket. Then you need to move those funds from the voluntary after-tax solo 401k bucket to the Roth solo 401k bucket. Well, Fidelity has a form that you would fill out. It's titled One-Time Withdrawal Investment Only Retirement Account Form. You would fill out that form and upload it to Fidelity. Another way of doing it is you can call Fidelity and they can move those funds over the phone from the voluntary after-tax solo 401k bucket. So from this bucket right here over to the Roth solo 401k. So you can either fill out Fidelity's form titled One-Time Withdrawal Investment Only Retirement Account, or you can give Fidelity a call and they can convert those funds from the voluntary after-tax solo 401k to the Roth solo 401k account. So it's all done internally by calling Fidelity or filling out their form. Now, once those funds have been moved, that is converted from the voluntary after-tax solo 401k bucket to the Roth solo 401k bucket, make sure to complete our online conversion form, which is how we collect the necessary information to issue that form 1099-R to report that mega backdoor Roth conversion to the IRS. So if you're a client of my solo 401k financial, you want to fill out this form here. And you'll want to do that by December 31st so that we collect the necessary information to issue that form 1099-R. Here's a link to the procedure on our website that breaks down how to process that mega backdoor Roth solo 401k conversion at Fidelity for a solo 401k offered by my solo 401k financial. So visit that link there for the full step-by-step procedure, including how to fill out Fidelity's form to have the funds converted from the after-tax to the Roth solo 401k, or you can give Fidelity a call instead to have those funds converted. This slide here is an example of converting voluntary after-tax solo 401k funds to the Roth IRA at Fidelity. Because remember, the mega backdoor Roth strategy allows you to either convert the voluntary after-tax solo 401k funds to the Roth solo 401k, or they can be converted to the Roth IRA. So this slide here is an example of those who make the contribution to the voluntary after-tax solo 401k bucket. They then have a Roth IRA at Fidelity already, or they open a new Roth IRA at Fidelity. So you can use an existing Roth IRA, or you can open up a new one. And it's also at Fidelity. But instead of converting it to the Roth solo 401k, you convert that voluntary after-tax solo 401k contribution to the Roth IRA. It's a very, very similar process as converting it from the voluntary after-tax solo 401k bucket to the Roth solo 401k bucket. And that you're still going to fill out the same form. That it's a form Fidelity requires. It's their form. It's titled One-Time Withdrawal Investment Only Retirement Account. Or you can call Fidelity and ask them to see if they will go ahead and convert those funds over the phone directly from the voluntary after-tax solo 401k bucket to the Roth IRA. And again, just like we need to have our online conversion form filled out so we can report that non-taxable conversion to the Roth IRA, you need to also fill out this online form when converting funds from the voluntary after-tax solo 401k to the Roth IRA, just like you would fill one out when converting voluntary after-tax solo 401k funds to the Roth solo 401k. So in short, my solo 401k financial, not Fidelity, will issue the form 1099-R for reporting the mega backdoor Roth solo 401k strategy, whether you convert the funds to the Roth IRA or to the Roth solo 401k, because Fidelity is just serving as the financial institution holding the funds, the custodian of the solo 401k funds for a plan offered by my solo 401k financial. So it's my solo 401k financial that would assist you in performing that reporting as long as you timely request it. So we have a question here from Dan. Good morning, is SEP separate from a solo 401k? Great question, and it is. And we've actually presented several webinars on that topic where we've compared the SEP IRA versus the solo 401k. So they are different. So if you subscribe to our YouTube channel, you can view that video catalog. We have over 950 videos there. But a SEP IRA, just to give you a high level illustration here, a SEP IRA versus a solo 401k, with the SEP IRA, you can only make employer contributions. Whereas a solo 401k, you can make both employer and employee contributions. Also with the SEP IRA, you cannot make catch-up contributions. A solo 401k allows for catch-up contributions for those who are age 50 or older, for example. You can contribute $7,500 as a catch-up contribution. Or if you're age 60, 61, 62, or 63, you can make a super catch-up contribution of $11,250. The SEP IRA does not allow for either type of catch-up contributions. Also, a SEP IRA does not allow for participant loans where you can borrow from your plan. That's only available to solo 401k plans. Also, a SEP IRA does not allow for the auto contribution tax credit, which we'll talk about here in a little bit. That's where the IRS is essentially subsidizing the cost of having a retirement account over and for a total of $1,500 and $500 increments for a total of 3 years. That's only available to 401k plans, not SEP IRAs. So those are just some examples. And of course, the SEP IRA does not allow for the mega backdoor Roth strategy. That's only available to 401k plans. So good question. Go ahead and keep typing over your questions during the live webinar, and we'll get to those as we continue here. So we've already talked about Fidelity's limitations when it comes to their solo 401k plan versus a solo 401k plan offered by my solo 401k financial, but this slide here kind of breaks it down some more. So Fidelity Solo 401k plan does not allow for voluntary after-tax contributions, and therefore does not allow for in-plan mega backdoor Roth conversions. So it doesn't have the mega backdoor Roth option. It only allows for employee and employer contributions. So common misunderstandings regarding the Fidelity Solo 401k is that many advisors and CPAs assume that Fidelity allows for the mega backdoor Roth strategy and even solo 401k participant loans. It does not. So it's a prepackaged plan, but it doesn't have all the bells and whistles like a solo 401k from my solo 401k financial. It also does not come with the auto contribution tax credit of $1,500. So you're leaving $1,500 on the table when you use Fidelity for a solo 401k instead of a provider like my solo 401k financial. So you need to open a solo 401k plan with the provider like my solo 401k financial who will draft custom plan documents that will include the mega backdoor Roth strategy, being able to borrow from the plan through the solo 401k participant loan, being able to invest in alternative investments like real estate, crypto, private equity, precious metals, and so forth. And of course, that has the auto contribution credit built into it. So that's why when you want to compare a solo 401k offered by Fidelity to a self-directed solo 401k, aka solo 401k from my solo 401k financial, you need to understand the differences, which we've already elaborated on. And this slide here further elaborates on that. So it's a solo 401k from my solo 401k financial allows for voluntary after-tax contributions. And of course, Roth solo 401k contributions, whether employee Roth or employer Roth solo 401k contributions, as well as in-plan conversions, multiple holding accounts, full checkbook control, participant loans, and of course, the auto contribution credit. So here's an example scenario of utilizing my solo 401k financial for making voluntary after-tax solo 401k contributions for processing the mega backdoor Roth. So if you have an account at Fidelity, so if you open a solo 401k with Fidelity instead of my solo 401k financial, your total contribution limit would be $48,000 for someone who is, actually this needs to read $48,500. That would be your total contribution limit for someone who's age 50 or older. And this is someone who is an S Corp, self-employed business who reports 100,000 of W-2 wages. So the way we get to the $48,500 figure is that the employee contribution is $23,500 using tax year 2025 numbers. So 23,500 plus a 25,000 employer contribution, which is 25% of 100,000. So 23,500 employee contribution plus that 25,000 employer contribution. That's how we get to the $48,500 contribution limit for an S corp, where you report 100,000 of W-2 wages. Now, compare that to my solo 401k, to a solo 401k plan offered by my solo 401k financial that allows for the voluntary after-tax contribution as part of the mega backdoor Roth. You can contribute $70,000 as a voluntary after-tax solo 401k contribution. So that's the overall limit for tax year 2025. You would make that $70,000 contribution to the voluntary after-tax solo 401k bucket, and then you would convert that over to the Roth solo 401k bucket. So that's how you can tell the difference there by utilizing the mega backdoor Roth strategy. Okay, let's see here. Looks like we've got another question here. Good morning. Am I eligible to open a solo 401k if I'm self-employed? No employees. My wife is in the process of buying a business that will have employees. I will not participate in her business. Good question. So you are eligible to participate in a solo 401k plan as long as your business will not do business with your wife's business, and vice versa. You can't have employees of your wife's business do work for your business. And you also cannot be an owner in your wife's business, nor can you be an employee of your wife's business. So as long as you put a wall in between, you would qualify to open a solo 401k plan. Good question. Okay, let's see here. Let's continue here. So transitioning from Fidelity. Let's say you already have a solo 401k at Fidelity, but you find out that, hey, wait a minute, it doesn't allow for voluntary after-tax solo 401k contributions as part of the mega backdoor Roth strategy. It doesn't allow for solo 401k participant loans. Well, you can restate. You can switch from Fidelity to a solo 401k from my solo 401k financial, and we can help you to still use Fidelity to hold the funds. We would, so yes, again, as I mentioned earlier, Fidelity offers their own solo 401k, but they also offer what they refer to as non-prototype investment-only brokerage accounts for a solo 401k offered by my solo 401k financial. So we can help you move that existing Fidelity solo 401k. So pick it up and move it internally to a solo 401k plan offered by my solo 401k financial. We'll help you open up new brokerage accounts at Fidelity. And then we'll help you to transfer your existing Fidelity solo 401k, so restate it. So if you have cash or securities, those funds never leave Fidelity. Instead, they get moved over internally from that existing Fidelity solo 401k to the new solo 401k offered by my solo 401k financial. That's known as a restatement. And when it's processed as a restatement, that means it's not going to trigger having to file a Form 1099-R or a final Form 5500 easy, which apply when you close the plan. Here, you're not closing the plan. You're effectively switching from Fidelity solo 401k to a solo 401k from my solo 401k financial. And again, you can use Fidelity's brokerage accounts forms, and we can help you open up those new brokerage accounts for the plan offered by my solo 401k financial. Unfortunately, Fidelity will not allow you to use that existing solo 401k's brokerage accounts because those are for the Fidelity solo 401k. So they require that you open up new brokerage accounts for the solo 401k offered by my solo 401k financial, and to then move that existing Fidelity solo 401k internally, including the securities like stocks or index funds, without having to liquidate those in kind to the new brokerage accounts for the solo 401k offered by my solo 401k financial. And then you can immediately start making voluntary after-tax solo 401k contributions and process that mega backdoor Roth strategy. And my solo 401k financial will report that conversion using Form 1099-R as long as you timely request it. Okay, let's see here. I think that let's take a look at some. So again, one of the advantages of using my solo 401k financial is that it allows for the Mega Backdoor Roth Solo 401k strategy under their Solo 401k plan, but it also comes with the auto contribution credit of $1,500. It's a dollar for dollar tax credit equal to $500 per year for a maximum of $1,500 over 3 years. So if you open a Solo 401k with my Solo 401k Financial, or if you restate an existing Solo 401k from a provider out there, whether it's Fidelity or someone else, to a Solo 401k from my Solo 401k Financial, you would qualify for that auto contribution credit. The auto contribution credit did not become available until January 1st of 2024 and after. So if you are a client of my Solo 401k Financial, we can add that auto contribution credit to your plan if you open the plan with my Solo 401k Financial prior to December 31st of 2023. So existing clients would qualify for this auto contribution credit. We would need to update your plan to allow for the auto contribution credit. You can submit a support ticket through our website to inquire by having us add the auto contribution credit to your plan if you're an existing plan of my Solo 401k Financial from December 31st and prior. If you've opened the plan with my Solo 401k Financial prior, January 1st of 2024 and after, then we've automatically already drafted that plan for the auto contribution credit. There's the support ticket where you can submit a ticket to have that auto contribution credit added to your plan if you open the Solo 401k plan with my Solo 401k Financial from December 31st of 2023 and prior years. So more on the auto contribution credit. So in order to qualify for the auto contribution credit, you have to utilize a Solo 401k provider like my Solo 401k Financial, whose plan has that auto contribution built into it. It also has the applicable schedule forms attached that you would sign. A Fidelity Solo 401k plan does not allow for the auto contribution credit. So you can switch from Fidelity, a Solo 401k, to a Solo 401k from my Solo 401k Financial. And by adding this auto contribution credit of $1,500 to your plan, that's going to cover the cost of having a Solo 401k plan for about 7 years with my Solo 401k Financial. So again, with this auto contribution credit, the cost of having a Solo 401k is practically free for 7 years. So the $1,500 government stimulus is greater than the cost to open and maintain the self-directed Solo 401k for many years. And what's great about the auto contribution credit is that it's not merely a deductible expense, but rather a dollar for dollar reduction in your business tax liability. So it's much more favorable. Once we add that auto contribution credit to your plan, you can opt out of contributing to the plan. So you don't have to contribute. And you can decide to make contributions in whichever amount you want up to the overall limit. So in short, even though it's called the auto contribution credit, you're not required to make contributions in order to qualify. You are required instead to have a plan from a Solo 401k provider like my Solo 401k Financial, who will draft the plan to allow for that auto contribution credit. And you claim that credit over a 3-year period. So it's $500 per year for a total of $1,500 over 3 years. In each year that you claim that $500 credit, you need to file Form 8881. We have a tutorial that has a PowerPoint and a video presentation to help you walk you through that, preparing and filing that form. It's only a 2-page form, and you'll be able to claim it for 3 years. Okay, looks like we've got some more questions here. Let's take a look at that here. So, looks like another follow-up question. Okay, so So I cannot be on the note loan for the purchase of or own any interest in her business. We live in a community property state. Would that impact my ability to open a solo 401k plan? Yes, it will, because if you're, let me see, you're saying that loan for the purchase or own any interest in her business. So no, you're not going to be able to own any interest in your wife's business, because now you're going to be considered an owner and a self-employed, or excuse me, an owner in a business that employs full-time W-2 employees. So the key is that you are not an owner in her business. That's very important. Good question. Okay, so it looks like we've come to the end of our presentation. So go ahead and subscribe to our channel, please, so that you receive notifications when we go live. Take a look at our My Community, where we have over 30,000 members. If you're a financial professional, whether a tax preparer, CPA, accountant, insurance agent, business broker, um, financial advisor, mortgage broker, real estate agent, go ahead and join our community. And you can actually post guest blog posts where you can flex your knowledge and even link that post back to your company's website, so that the 30,000 plus eyeballs on our My Community can click on that link and visit your website, so they can see what services you offer, and they might even reach out for your services. So again, it's free to join, and you can post guest blog posts as well. All right, that's it for today's session. Thank you so much for investing your time with us. Your time is valuable, and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this community. We'll be back here this afternoon with more crucial content to help you secure your retirement.